Markets are soaring, sentiment is euphoric, but tomorrow could be a setup. The stock market just hit another all-time high, and that's exactly why you should be nervous. Because when everything looks perfect, that's often when the trap is set. Right now, the market is riding one of the longest uptrends we've seen in over 25 years. But under the surface, something doesn't feel right. Earnings are rolling in, Powell is scheduled to speak, and traders are starting to shift. Now, I'm not saying a crash is coming tomorrow, but there's real data, not just gut feelings, that say things are about to turn. And if it does, a lot of people will be left holding the bag. So in this video, we're going to break it down. What's actually happening behind the scenes, why the timing matters, and why the next 24 hours could trap retail investors hard. And no, this isn't just bulls versus bears. It's Wall Street versus you. Again. Chapter 1. Market Streaks and Historical Danger Zones. Right now, the Nasdaq is doing something it hasn't done since 1999. It has closed 60 straight days above its 20-day moving average. That's the longest streak since the dot-com bubble. And we all know how that ended. The last time this happened, the market kept rising until it didn't. Back then, the streak ran for 77 days. But once it ended, a pullback hit almost immediately. The Nasdaq dropped for weeks. Now, this doesn't mean history will repeat perfectly, but it does rhyme. And if you're wondering what usually happens after these long streaks, it's not good. Statistically, after these setups, the market is only positive 11% of the time 3 days later. Yes, just 11%. That means nearly 9 out of 10 times we see red. And when you combine that with the current stretch, the risk becomes clearer. We're not just overbought, we're overstretched, both in price and time. Even a small drop could snowball quickly. So yes, the trend is strong, but trends break. And when they do, they don't warn you first. This is the kind of setup that punishes that last buyer the hardest. Chapter 2. Euphoric highs plus weakening breadth. Now let's talk about why this rally feels off. Yes, we're at all-time highs. Yes, some stocks are exploding. But the way we're getting there doesn't inspire confidence. See, real bull markets have strong momentum. They push higher with force. But lately, what we're seeing is something different. The market climbs in the morning and then gets sold off hard into the close. That's not momentum. That's hesitation. That's big money locking in profits, while retail is still buying the top. Even heat maps tell the story. There aren't many stocks leading this rally. There's no clear strength, just fewer signs of panic. And here's what makes that dangerous. When leadership fails, pullbacks get sharper, buyers vanish, and sellers don't wait around. We've also seen this before. Back in June, new highs came with excitement. Now, new highs come with shrugs. That shift in behavior? It matters, because euphoria doesn't die all at once. It fades, just like this rally might. And here's a hot take that might trigger some people. If you're still blindly buying every dip right now, you're not investing, you're gambling. Chapter 3. Key technical levels being tested. Let's get into the charts, because what the market looks like right now matters. SPY has had a strong bounce. It's recovered hard, but it's not out of danger. There are a few key levels we need to watch. First, $631.50. Above that, we've got $633.80, and then $636.70. Those are the next big ceilings. If we blast through those, fine. But if we stall there, that's a red flag. Now to the downside, and this is where it gets interesting. $628.20 is your first key support. Below that, $626.25, and then $624.50. These zones have held before, but if they crack, the floor might give out fast. Also, traders are watching volume and order flow. Bookmap data shows thick sell walls around Palantir at $170 to $180. That means sellers are ready, not asleep. So don't just look at price, look at who's behind the price. If we gap down tomorrow under $628 and volume spikes, watch out. That's not a pullback. That's momentum flipping. And remember this, support is only support until it isn't. Chapter 4. Earnings Landmine Setup. Now, let's talk about earnings, because this week isn't just busy, it's loaded. 23% of the S&P 500's total market cap is reporting earnings right now. That's a massive chunk. And it's not just any names, it's the heavyweights. Tesla, Google, Intel, AMD, Coca-Cola, Lockheed Martin. These aren't side characters, they move the market. Now here's what's tricky. The market is already at extreme highs, so even good earnings might not be enough. We've seen this already. Netflix reported solid numbers and still dropped 5%. Because in this environment, good isn't good enough. Investors want perfection, and anything less gets punished. Palantir, they crushed expectations. Revenue up 48% year over year, raised 2025 guidance, and the stock still faced resistance at $170 plus. Now imagine what happens to stocks like AMD or Tesla if they just report okay numbers. We could see sympathy selling across whole sectors, semiconductors, AI, even big tech. Also, keep in mind, Jerome Powell is speaking right in the middle of all of this. That adds fuel to whatever fire gets started. So here's the setup. High prices, high expectations, tight stops, and the most crowded trade environment we've seen all year. 1 week earnings print, and the dominoes start falling. This isn't just a news cycle, it's a landmine field, and tomorrow we step right into it. Chapter 5. Macro Catalysts Colliding. Now, let's zoom out for a second. Because it's not just earnings and charts causing tension. There are macro catalysts piling up all at once. First, Jerome Powell is scheduled to speak 1 hour before the market opens. It's not an FOMC meeting, but it's still Powell. That alone can shake things up. He'll be speaking at a large bank capital review. It sounds boring, but it's not. Any comment about bank regulation or tightening capital rules, that could spook the market fast. Next, we've got trade tensions. The EU just suspended retaliatory tariffs for 6 months. That helped fuel the last rally, but it's a temporary truce, not a solution. Meanwhile, India is under fire for buying Russian oil. That adds more geopolitical friction. And with war still ongoing in Ukraine and the Middle East, global uncertainty remains high. Now here's something telling. Silver and gold are spiking. SLV just popped 2.14%, and the options activity was explosive. That's not random. That's money flowing into safety. When traders start buying hedges and metals are ripping, it's not about greed anymore. It's about fear. And when fear shows up before earnings, you need to pay attention. Chapter 6. Sector Highlights, where the traps are. Alright, let's look at where the traps actually are, because some sectors are flashing warnings, loud and clear. First, AI and tech. Palantir is up 971% year to date. Robinhood has skyrocketed from $12 to over $100 in 2 years. These are massive runs, and they rarely end softly. Stocks like AMD and Nvidia are still climbing, but they're sitting on thin ice. Expectations are sky high, and even one bad earnings report could cause a chain reaction. Next, meme stocks. American Eagle surged 23.6% in a single day, thanks to a Sydney Sweeney ad. Yes, that's real. This is 2025. It's a fun headline. But underneath, the stock has an 11.4% short float. That's the kind of setup that turns into a short squeeze or a crash. Also, Open Door jumped over 100% intraday, then halted for volatility. Traders are chasing wild moves, and when that happens, liquidity disappears fast. Even safe sectors are moving oddly. Energy fuels, UU, is up 225% since April. Silver and crypto are being treated like safe havens again. So what does that tell us? It tells us that we're in a market driven by emotion, not logic. And when emotions fade, the exit door gets very crowded very fast. Chapter 7. Big Money Behavior and Positioning. Now here's something most retail traders ignore, but shouldn't. What the big money is doing. Institutions aren't panicking, but they're not chasing this rally either. They're positioning quietly, with time on their side. Just last week, someone bought $3 million worth of CWEB calls expiring in 2026. That's not a trade. That's patience. Another big bet? $236,000 into Lyft $16 calls for November 2025. So while retail is playing checkers, big money's playing chess. They're not betting on tomorrow. They're building for volatility. And here's the key part. They're buying time and staying away from short-term hype. They're letting overbought tech exhaust itself. That's what smart money does. They don't ring bells at the top. They just quietly shift and wait. And when you see that shift, it usually means the next move is close. Chapter 8. What this means for tomorrow. Alright, let's bring it all together. We're sitting at record highs, but the foundation is shaky. We've got Powell speaking, we've got major earnings dropping, and we've got technical setups that are stretched thin. Add in soft breath, exhausted trends, and emotional retail trading, and we get the perfect recipe for a trap. Tomorrow isn't about guessing up or down. It's about recognizing the setup. If SPY opens below key support or earnings disappoint, momentum could flip fast. If Powell spooks the market even slightly, the drop could get sharp and very real. This is not the time to YOLO into green candles. It's time to tighten your plans. Know your levels. Set your stops. Play both sides, or don't play at all. Because traps don't care about your feelings. They just wait for you to overcommit. Then snap shut. So, is this the top? Maybe. Maybe not. But it's definitely a turning point. We've shown you the data, the technicals, the psychology. Now it's your move. Let me know in the comments. Are you positioning for a pullback or still riding the wave? Either way, don't get trapped blindly. Like, subscribe, and hit the bell if you want more data-driven, no-fluff updates like this one. And hey, if Powell hints at anything tomorrow, even slightly dovish or hawkish, the market's next move could be violent. I'll break that down in the next video.